Are mortgage interest rates really going to go sub 5% in 2023? That's the $1,000,000 question everyone wants to know. What's going to happen with housing and what's going to happen with mortgage interest rates? In today's video, I'm going to give you 2023 rate and housing forecast. And I'm not just going to give you the forecast, but I'm going to tell you why. So stay tuned to the very end when I tell you exactly why and the data that supports interest rates coming down in 2023. All right, Matt, the mortgage guy, residential mortgage broker, licensed across the country. If you want to connect with me and my team, it's easy. Go to greatmortgagebroker.com, fill out that quick form, let us know where you're at and how we can help. No matter where you're at in the US, we're more than happy to help. Get you pre-approved, get you educated, empower you through education to make good home buying decisions. So in this 2023 rate and housing forecast, I got to give credit where credit is due. Barry Habib, my friends at MBS Highway, put together a great slideshow talking about what's going to happen with rates and what's going to happen with housing in 2023. My job is to bring this to you in digestible fashion so a fifth grader can understand it. So I'm going to go through this slide deck and I'm not going to give you any fancy mortgage speak. I'm going to give you speak that you can understand, and I'm going to show you why interest rates are coming down. Stay tuned to the very end. I'll give you an exact prediction of how fast and how low they can go. So without further ado, 2023 rate and housing forecast. First and foremost, let's talk about what drives mortgage rates. And I think I've said this in plenty of other videos. It bears repeating. Inflation drives mortgage rates. And rather than just tell you as inflation comes down, mortgage rates are going to come down, we're going to show you, right? This is a graph. The blue line is 30-year fixed rate mortgage. And this pinkish line is the CPI, Core Consumer Price Index, otherwise known as inflation. And they follow each other. The only reason why mortgage rates didn't spike up sooner as inflation started to spike up is because you see this QE period. QE, quantitative easing, basically means the Fed was buying mortgage-backed securities. So the Fed was, propping up the cost of mortgage-backed securities and the value of them by buying their own stuff. When they stopped doing that, as you can see, that's when mortgage rates really started to rise, the beginning of 2022, right? So inflation coming down, mortgage rates to follow. More of this plain data to see in the slides ahead. This is another graph that I've talked about. I don't know if I've shared it, but talking about when will inflation peak and tracking these numbers, I've made a few videos where in October, November, and December, we looked at the last month's inflation readings because September's inflation reading comes out in October, October's comes out in November, November comes out in December. The December inflation reading is going to come out the second week of January, so look for that. But these are year-over-year numbers. We knew, and I remember listening to Barry and his team at MBS Highway and sharing with whoever would listen that we were expecting higher year-over-year inflation numbers during the summer months because look back to 2021. We had really low readings. So when they're measuring inflation year over year and we've got such a low baseline, of course they're going to come in high. Well, now we've got the opposite effect. October, November, December of 21, January, February of 22, which are these 5 months here. As inflation numbers come out for October, November, December of 22, and then January and February of 23, these are going to be a lot lower because they were so elevated a year ago, right? And so stay tuned for more low year-over-year inflation numbers, which is going to be a signal that inflation is coming down and mortgage rates are going to follow. This is kind of a cool graph to show that shelter costs are lagging. Shelter cost, how much does it cost to rent, how much does it cost to buy, how much does it cost to live in a place. That's what shelter costs mean. And the reason why this is important is because shelter makes up 39% of that inflation number. So when they're measuring inflation and they're measuring CPI, 39% of it is shelter costs. And so whether or not this number is accurate or it lags is very important, because it's going to translate into an inflation number that's either higher than reality or lower than reality. And so real quick, in layman's terms, we are right here, and shelter costs have been coming down for quite some time, but the data hasn't caught up yet, right? If you look at the CPI rent year over year change, it's actually trending up. And you're like, so the consumer price index rent is going up, but really, like, year over year true cost is coming down. How does that happen? Because there's a lag effect, right? We're looking at data that's old. And this is an attempt to kind of show and illustrate, shelter costs are lagging. This is what real shelter costs are, coming down, right? This is January of 2023. And this is like what shelter costs look like in that inflation report, right? They look like they're headed up, but we're already past it, right? If you go back, like, we've seen the increase in shelter costs and we've seen it come down. We're already here in real life. This CPI read, which is 40% of our inflation number, just has not caught up yet. So hopefully I simplified that enough, just letting you know that, like, we know the data that's going to be on future reports because it's what's happening today, right? Today's data is going to get on a report next month, and then it's going to show up in some of these numbers months down the road. All right. So, prices have come down across the board, right? We saw peak inflation from most people's standpoint, right? Like, and food, gas, clothing, all the reports show that stuff is coming down. And that's why CPI inflation has started to come down. But shelter costs, which is like 39%, 40%, almost half of that consumer price index, that inflation number, has not come down. It's still showing increases due to this lag effect that we just showed. So this is a reason why we haven't seen rates come down faster sooner, but they coming. Rest assured. Okay, now this is a totally separate topic, but also something that is a tailwind and showing that we're going to see lower interest rates in the future, right? This is something that, in order to keep it as simple as possible, blue line, 10-year Treasury, yellow line, 30-year fixed rate mortgage. Generally speaking, the 10-year Treasury and the 30-year mortgage see a normal spread, and this is right here in the middle, of 175 to 200 basis points. And you can call that 1.75% to 2% if it's easier to wrap your head around. Mortgage folks, analysts use the basis points instead. 100 basis points is 1%, but however you want to look at it, right? When the 10-year Treasury is at 4%, the normal spread says interest rates are at about 6%. And it's been like that over a 35-year history. 2022, we've seen this humongous 300 basis point or 3% spread, where the 10-year Treasury might be 3.5 and rates are 6.5, or it's 4% and mortgage rates are 7%. At times, it was even higher than 300 basis points. And so to go back and revert to normal would mean interest rates come down. As of, the markets being closing out 2022, the 10-year Treasury was 3.83, if I remember correctly. And, so the spread is probably in the 270 basis point range, 2.7% range, if the 30-year fixed rate's at 6.5, right? This is going to come down. But before you understand that, you got to ask, like, why is it 300 currently? Well, it's 300 currently because the value of a mortgage-backed security can be tied to how much servicing value it has. Servicing is the person holds the mortgage and collects the payments. And, mortgage companies that write millions of mortgages sell these mortgages. Somebody buys these mortgages and says, okay, I'm going to service it. I'm going to collect payments and interest, right? If the servicing is less valuable, nobody wants to buy it. To me, it's a clear indicator of the secondary market saying mortgage rates are not going to stay this elevated for very long. Therefore, I don't want to buy your 7% mortgage note. I don't want to buy your 6.75% mortgage note. You know why? Because someone's going to refinance it when rates go to 5.5%, when rates go to 5%. So I'm only going to get 9 months of servicing. This thing isn't as valuable as you say. Servicing value is measured in months. And if they don't expect it to be 6, 9, 12 months before somebody refinances this, it goes down in value. To me, that says the smart money is betting on mortgage rates going down, right? So again, if and when the 10-year Treasury goes to 3% and this normal spread comes back because rates are down and servicing values are up and this spread decreases, we'll be back in the 5% range. Later on, I'll tell you exactly where I think we'll land and why. All right. It was up to 300 basis points. It is narrowing, right? And we all know that rates at one point peaked at about 7.5%. They've already come down to 6.5%. As they continue to decrease, this spread is going to continue to narrow. Watch and see. All right, this is just showing, the 175 to 200 basis points and where that's at. Another strong tailwind that basically tells you that mortgage rates are going to come down is knowing that inflation comes down during recessions. If we're not already in a recession, we're very close to one. Like most recessions, we're probably going to hear about it once we're already out of it. But check out these. These are interesting graphs. Just if you follow the economy and recessions, credit card and other revolving debt was steadily increasing. 2018, 2019, 2020. And then here, this is a big, fat steroid injection of stimulus where, bam, people got to pay off a lot of credit card debt because they was getting basically a supplement to their income, right? Those who totally lost their income, maybe it was all of it, but for a lot of people, it was a supplement. They were still receiving income. They just got stimmy checks as a supplement. So a lot of this credit card and revolving debt was paid down from somewhere in the 860 billion range down to 740 billion. Well, once stimmy checks go away, people are still firing stuff off on credit cards. And one thing I will say is that it might have done people a disservice, right? To get used to the extra income coming in, continue to spend like they had it, but not have it to pay it down, right? Might be a reason why we're close to $1 trillion in credit card and revolving debt, but I won't belabor that point too much. Personal savings rate, another one that saw a big spike once we had some stimulus, and that's continued to dwindle. What these two charts are telling you is that credit card and revolving debt is higher than ever. Personal savings rates are continuing to dwindle to lowest levels in history, right? Like this is sub 3% from, a peak of near 35% personal savings rate. So there's that. This is another just recession indicator giving us further evidence, right, that we're in a recession. Recession is going to cause inflation to come down. Inflation comes down, mortgage rates come down. This is a housing demand, household formations chart, which is interesting, right? Because the more household formations there are, the more demand you're going to see. Other things play into this, right? Like mortgage interest rates and affordability. I get it, right? But more household formations is going to mean more housing demand. I think less households are being formed, and this might have been affordability, people moving together, right? During these tougher economic times. But at the same time, while household formations are steady or going down, we're also seeing less housing starts completed, right? Household formations at 1.3 million, total new supply at 1.4 million. If builders hadn't learned what they learned 15 years ago, they might be continuing to build, but a lot of them put the brakes on, right? So less new supply out there, along with people sitting with low mortgage rates that aren't listing their homes for sale. Like, we're going to have housing supply issues with those two things happening. Builders not building as much, people not selling due to the fact that they're in really good mortgage products and rates. So this will be something else to look at in 2023. 115% home price increases over the last 10 years, right? Over the last 2 years with that steroid injection, we went up unnaturally, up 39%. So this graphic says down 2.5%. I know in your markets, and I'm no dummy, right, that some markets are down 8, 10, 12%. Hardly a crash, right? If the average is up 39% over the last 2 years and it's down 2.5 or 5%, it's a little give back of some unnatural steroid injection, low interest rate environment appreciation. Some of that will be given back, no doubt, right? Like if this was normal appreciation, we'd be down here, right? And we'd be probably 20% lower than the peak. Some markets are going to give back 2.5%. Some markets are going to give back 10. Will some markets give back 20% of the appreciation they saw over the last 2 years? Yes, I think so, right? But overall, to say that housing is going to crash nationwide, a stretch. Nicest way to put it. Okay, I'm going to go through affordability. Before I do, I'm going to say my piece about, listen, I know it's tough. I talk to consumers every single day. So I know that affordability is an issue. I know that it's tough. I know that like these conversations I'm having week in and week out, it's stressful. It's really something that, people are struggling with. I take home $7,200. My mortgage payment is going to be $3,400. I don't know if I can, manage this. I get it, right? This is just an illustration that MBS Highway did. I think that it shows how it's not as bad as it seems, right? Not saying affordability is not an issue. Not saying buying your first home is not tougher than it might have been a few years ago. But let's look at some of the stats, right? If homes went up 10%, which we're starting to see prices claw back, right? So this might even be less, right? If you could buy something in 2021 for 400, chances are you can buy in that same market, depending on your market again, for pretty close to 400. And by the way, you might get some seller concessions to buy this rate down, right? Because this is basically saying home prices went up by 10% and rates went up by 2.75%. So you're paying $900 more per month. I'm saying you probably don't have to pay this 10% premium, and you're going to get some concessions to buy this rate down. We're locking people in every day, 575, 599. Some of the buy downs put them in a 399, 499, 599. I think we just did one where it was 344, 444, 544. So there's definitely things to do to help stave off this big spike in monthly payment that is the affordability issue. But this is kind of like a worst case scenario, right? So household income is $9,000 a month. If you look at the ADP data, 25 million households, people who stayed in their job got a pay increase of 7.6%, right? And this is to counteract this inflation, counteract the affordability issues. People who switched jobs saw a 15% increase in their income. Let's average it out. More people stayed than switched. 9% increase in your salary would mean you got an extra $810 in income, right? So it's counteracting what this difference is. And like I said, a lot of markets, you don't have to pay a 10% premium and you get to buy the rate down. So it's not even that bad, right? But let's pretend it is. Let's also be real and say that gas and food and services, these things went up, right? So you add these to your budget. Now you're $1,150 more expensive than you were last year. Okay, I get it, right? We got to make it up somewhere. If you saw a 9% increase and you're continuing to add value and work hard and see, salary increases, let's say you get a 5% increase in your job the following year. Now you're up to $10,300. You've got a $1,300 a month increase in your salary. This is something that, like, I'm not going to bank on, you getting into a really, really tight situation with your finances, just banking on the fact that you're always going to get pay raises. But generally speaking, you get paid more in the future. That's just how it works. Okay. This is one showing what happens when rates go down to 5%. And again, I'm going to give you the prediction at the end. I think we're going to see 5% interest rates. Now, even if you pay a 10% premium, I don't think you do. I think in a lot of markets, if it sold for 400, you get to buy it this year for 400 as well. In a lot of markets, right? Then you got a 5% interest rates, more expensive than it was at 3.5. I get it. But if you've got 1,300 in pay increases and only 800 increases, still factoring in, that was still factoring in these higher food, gas, and service prices, which, oh, by the way, have come down, won't go back to, 2019 levels ever, likely, right? So anyhow, just a quick illustration on affordability. Don't want to belabor that one too much. So the housing forecast on what's going to happen in housing, right? We're going to see a recession-like slowdown. We've already seen this in many markets throughout the country. Different markets are going to behave differently. Like I said, some might be down 2.5% from the peak. Some might be down 20% from the peak. But a lot of that is giving back some unnatural 39, 40, 50% home price appreciation over a 2-year period, which just wasn't natural, right? Incomes are going to continue to increase, which is going to help affordability. Very tight inventory environment. Like I said, people aren't selling and builders aren't building. So there's still going to be this very tight inventory environment. Rents are still expensive. Rents are still rising. With everything going up in cost, the cost of capital being a big one, right? Mortgage rates, rents are going to continue to rise, right? But inflation is going to come down, lower inflation. That's going to bring mortgage rates down. MBS Highway says low single-digit appreciation for most of the U.S. with a little pickup in activity, right? So 4 million homes might transact in 2023. Low single-digit appreciation is what MBS Highway says. You can look across a bunch of different sites for predictions. -4%, -2%, +3, +5, low single digit. I'm guessing MBS Highway probably has a 5 to 6% appreciation baked in there. Whatever the case may be, I'm just going to call it flat for my purposes, because I know that when I look at housing and owning real estate, I don't look at it like, is it going to go up 4% or is it going to go down 4%, right? Over time, it's going to appreciate. And if you're playing the long game, if you're Warren Buffett in the stock market, or you're like one of a bazillion real estate investors in the real estate market, it's a long-term play, right? So the year-on-year appreciation or depreciation shouldn't be like the leading factor for you in buying or not, right? So mortgage rate forecast, here's some headwinds that's going to maybe slow us from mortgage rates going down. And then I'm going to talk to you about some tailwinds, right? Quantitative tightening around the globe, right? What China's market does and what other markets do is going to affect us. Lack of foreign central bank buying is going to affect us. There's more debt to be financed, right? And so there's a lot of worldwide debt, and we all know as Americans what kind of debt we've got. This is going to be something that is a headwind for mortgage interest rates, right? A tailwind means stuff that's going to push us into lower interest rates faster is lower inflation. Mortgage rates will follow inflation, no doubt, right? So as we see inflation come down, mortgage rates are going to come down. Excess retail inventory. And this is interesting too, because I just read something where they tried to blame the storms on retail having more inventory, when it just might be that heading into a recession, people are buying less stuff, right? And so excess inventory means things go on sale. Do we have excess inventory in real estate? No. If we did, real estate would go on sale, right? More of the sale and the price depreciation we're seeing now is based on lack of demand. None of it is really based on excess inventory. But in the retail space, with goods, definitely seeing that. Increase in mortgage servicing value. We talked about that in that slide where we saw the spread go from 175 to 200 all the way up to 300 as interest rates come down and the servicing value increases, because people who are servicing these and buying mortgages in bulk aren't as afraid of all of it being refinanced in 6 months. That is going to help accelerate mortgage rates coming down. And then rates decline during recessions. Recession is likely. We're probably already in one, but they're just not going to let you know for another 3 to 6 months. But that is a strong tailwind for mortgage interest rates. So like I promised, little prediction, and I agree with MBS Highway, 30-year fixed rate mortgages are going to move near 5% during the first half of 2023. So call it the end of Q2. Call it May and June. Don't be surprised to see low 5% 30-year fixed rate mortgages. And oh, by the way, if we still got any sort of leverage on the buy side as real estate investors, as people buying their first owner occupied house, we're going to be buying those rates down into the 4s or even lower, right? The 10-year Treasury near 3% or lower. Again, that's that same chart where if the 10-year Treasury goes to 3% or lower, mortgage rates are going to be 1.75 to 2% above that, in that 5% range. So that's the end of the slideshow. And I think that for a lot of people, it's good news. Lower interest rates is going to make home ownership a reality for so many. If you got any questions for me and my team, more than happy to answer those. This is way more long-winded than I thought it would be, but hopefully it was valuable. If you got any value in this, like, comment, subscribe, do all the things. Go to greatmortgagebroker.com if you want to connect with me and my team. If you're looking for a real estate agent in the market you're in, go to homeandmoney.com/Matt. Thanks for watching.